The Monetary Policy Committee has met up in its bi-monthly meeting starting on Wednesday, which will end tomorrow. And there are several things which the MPC will consider in the meeting while making decisions with regard to rates and the general economy at large. So let's try and understand the backdrop of this prior to going into the expectations from the MPC. So there have been signals of a strong economic recovery, at least after the second wave of COVID. GST collections are at a 5-month high. Business and investments are also at a high, signaling that markets are at a high. Bond issuances are rising, and PMI is looking up. In fact, in the services sector, PMI is at an 18-month high, which is definitely encouraging. CPI inflation for August has eased, and government capex is up. Now, of course, despite all of this, there are several concerns which the RBI will have to look into. So one is that yields have moderated, or rather yields had moderated and have risen up again, which may be a cause of concern. Yields were at around 6.28% yesterday, the 10-year yield. Credit growth remains muted within the system. WPI inflation is upwards of 11%, which will definitely be a cause of concern, and RBI will not want that to filter down into CPI. And crude prices are up and coal prices are up, which means that energy is in short supply to a certain extent, and merchandise imports are up, which will kind of create an issue with regard to the trade balance, which the RBI will really want to try and address. We expect, however, the MPC to continue with rates unchanged. So the consensus view of economists at large is that the RBI will continue not to tinker with rates and continue with its accommodative stance. Markets too are expecting this, and RBI will try its best not to spook markets by making any sudden changes. So the immediate next step will be that the RBI will be looking to address the excess liquidity within the system. This may give, or rather they may give a timeline for liquidity normalization, as you would call it. When we spoke to the chief economist of UBS, she believes that liquidity normalization will start in December, and there will be rate shifts which they are anticipating by March of 2021, which will see the 10-year yield go up to 6.5%. So as regards growth as well, UBS believes that growth has softened for September and in fact till the 3rd of October. And however, they are quite bullish on the growth front. They believe that by December, given the festive mood in the months of October and November, we'll see growth reignite to a certain extent, and December we'll see really good and solid growth. Morgan Stanley believes that growth within the economy is continuing to improve. However, there is a need to keep a watch on supply side disruptions from a growth perspective. Inflation is moderating basis August numbers, as well as what we are expecting in September to come out on the 12th of October, is that the pace of moderation is slow. However, inflation is moderating, and we will have to keep an eye on that pace of moderation, and I'm sure the RBI too will be cognizant of that. Further, oil prices are rising, which is definitely a concern and which will impact inflation. Among other issues are, of course, the trade and the fiscal deficit. Given that oil is rising, that will definitely be of some relevance, as well as RBI may be looking or keeping one eye on stemming or in trying to control the depreciation of the Indian rupee. So lots for RBI to think about. Should be a very interesting commentary coming in.